Hey everyone, welcome back to the show. You can see me today. As I mentioned in the last show, many times the show will be audio only, like a typical podcast, and other times it will include visuals like today. Not just so you can see me. Hi, I'm Christopher Blockham, and it is nice to put a picture with the person you're listening to, but more importantly, I want you to be able to see content like charts, graphs, numbers, and other things. Something to help paint a picture of what we are discussing. There will be some of that today. So in the last show, we started with the foundation, to save or not to save. Now again, I'm certainly not telling you not to save your income or save your money. I'm just giving you information so that you can see that you may not be saving what you think you're saving. You actually might be losing money by having it in a savings account at a bank, especially if that local bank is using local savings rates, like what you see here on the screen, 0.10 to 0.15%. So here on the screen, again, you'll see the local savings rates and you'll see the online savings rates. This is just a brief summary of where we left off. Savings accounts, local rates, online rates. And to give you an example here at the right, for every $1,000 that you save, you will get a return of $1 over the course of that year with a 0.10% rate. With the online rate, for every $1,000 you save, you will receive $20 when you come back after that 1 year. And again, this is every $1,000. So if you had $2,000, then that number would be $2 or $40. If you had $4,000, that number would be $4 after 1 year or $80 after 1 year if you have $4,000 you were saving. So this is for every $1,000, not just $8,000. So as we look at our first chart, you get to see a representation of what I've been speaking about. So you don't have to imagine it. You can see numbers on paper. So if you look at our same multiples of 1,000 or $1,000 to keep the math simple, if we place $1,000 in a savings account, a local savings account at local savings account rates, those 0.10, 0.15%, we come back in 1 year, we've got $1,001 right here. Now, unfortunately, again, at this rate, inflation, which is the measure, typically the increase of everyday goods and services that moves at a clip of 2% on average versus 0.10% of the local savings account. When we come back in a year, whatever we were going to buy for $1,000 that we've got $1,001 to show for it, the cost of that is now $1,020. So that's called buying power, and we've lost buying power. So we've lost the dollars that we've put into the bank. If we had something we wanted to buy for 1,000, we've got 1,001. It's now cost $1,020. And you may say, well, I can solve that problem just by saving more money. Well, that's the solution to some problems, but not this problem. In fact, whether we add more dollars or more years, as we see here, in 4 years, things are just worse. And 4 years, if you left that $1,000 in the bank and you came back 4 years later, you would have $1,004, and whatever you were saving for, whether it was a rainy day or just everyday life goods and services, that inflation increases at 2%, that would cost whatever those things are, it would be $1,080. So you are short about 2% or 1.9% to be exact. So you're not saving, you're going in reverse. And what if we do add more money? We bring in a calculator here, and let's just say we were saving $4,000. So $4,000, 4 times 1 would be $4. So if you come back in 1 year's time, you would have $4,004. That is okay. However, if we do 20 times 4, representing the $4,000, whatever everyday life or goods or services that you were saving for would be $4,080. So what if we did more time and more money? So we took the $4,000 and you had it saved, you saved it for 4 years. So 4 times 4, 16. So $4,016 is what you have in that local savings account. And if we do 80 times 4, 320. So 4,320, $304 difference. You see, we just cannot shake that difference between the local savings account rate and inflation. So as time goes on and you add more money, the it just gets worse and worse. This gap just grows more and more. So I think I've said enough about this. I think at this point you know that if you follow this line, local savings account, you're playing catch up. If you follow this line, local savings account rate, you're playing catch up. Here, if you do move what you're saving to a bank that has an online savings account, those rates are typically in line with inflation right now. At least you're staying afloat. But what if you could follow this line? You can see we're falling behind here. We're staying afloat here. But what if you could get ahead? What if when you put that $1,000 in the bank and you came back to it after 1 year, you had $1,080 and whatever you were saving for cost $1,020. Now you have saved, you've made your purchase of whatever you were purchasing, and you still have some left over. That is getting ahead. And getting ahead isn't a bad thing. You work hard for your earned income from your business or your place of employment, your job, your career. You need to do what's best with those dollars. This is good for you, good for your family, good for your loved ones, good for generations to come. There's no need to waste it. Heck, if I'm looking at this chart for the first time, or I'm you looking at this chart, I don't want this orange line. I don't want this blue or this gray line. Give me the yellow line. I work hard for my income. I'm sure you do too. I spend a lot of time to get this income. And we're going to come back to time for income, time for money. We're going to come back to that. But yeah, give me the yellow line. I want the best return I can get on the money that I have set aside or can set aside to save or, as you see, invest. The good thing for you, though, you're in the right place. You're going to learn all about this yellow line and what these investments or alternative investments are. Now, there's one other bank offering that you may hear people refer to as saving. Um, some people may mix the term and call it an investment, but let's talk about that. It's called certificate of deposit. The good thing is that regarding CDs, you don't have to leave your dollars in there upwards of 5 years like you had to do in the past. When I looked, I saw these returns in as little as 1 year, which is not so bad. But the bad thing is that it's still just status quo, just flying right along the inflation line. Um, no really return on the dollars you put in there. So again, we're going to do better than that. We want the yellow line. We want to put dollars away and come back and for there to be more dollars than were there when we left it. And that's what you're going to learn about. The stock market. This is our first foray into real investing. We're going to talk about two avenues of the stock market, buying and selling and dividends. Hopefully two avenues that give you returns on your money and gains and not losses. Now keep in mind, this is a real estate investing show, but I do want to share with you other vehicles of investing your dollars. The S&P 500 is a measure of 500 large companies that trade on the stock exchange. The S&P 500 is thought to be a good indicator of the health or gains and losses on the stock market. So overall health indicator of the stock market. If you look at this chart, this shows performance of the stock market, or at least the S&P 500 over the last 20 years. I think you can see that volatility is probably an understatement. There's ups and downs, and there's a lot of that. Now, there's some significant gains in the market, and then there's some significant decreases you'll see. If we start most recently, we'll look at 2019 and see that was looked to be a pretty good year in the stock market. And see a gains of 28%. That's really good. We saw the year before negative 6%, and then some of the years before that anywhere between 0 and 19%. Some years before that 19%. The typical return is thought to be on the stock market about 7%. It just depends on who you talk to, who you ask. But I went and looked at the data, and I did it by I guess half decade. So I went at 5 years at a time, and we'll look at that table you'll see here on the right. But then there's also some significant losses in the market. So we look at 2008, which was, I guess, maybe called the Great Recession of 2008. A myriad of things from housing markets to mortgages to interest rates increasing. Myriad of different things went on in the economy that caused that, and you can see this was a steep loss. And then we look back to 2000, the dot-com bubble bursting. A myriad of things from tech stocks being overvalued to, again, interest rates rising at maybe the same time. But again, a myriad of things that certainly you can read about, a myriad of things that caused that to happen too. So we saw significant losses in 2000 as well. So the stock market buying and selling is like many other things in life. It said you buy low and sell high. So you realize your gains in the stock market in at least one way, which is buying and selling, like I showed you on the prior bullets. So if you bought, let's say you bought stocks when the stocks were valued very low, some of them, at least in '08, and then some of the following years coming, they went up, they went here. That would be a great gain. Now you would have to sell at that time. So if you bought in 2008, 2009, around this time, and then you sold some of the years later in this time, that would be awesome. Even if you sold any time in the future, that would be awesome if you bought and were able to buy stocks when the market was down 38%. Below value. So these are losses. This is below the line. This is if you had dollars in stocks in 2016 here and then had to sell here, that would be a loss. So stocks are said to be long term. There's a short game and a long game. So they're said to really be a long term gain. There is stock trading that can be done on a daily basis. And somewhere between daily and long term. Like I said, you can see here if you bought stocks here and then you waited some years later and sold them, they would be great. If you waited, some years later again and sold them, they would not be as great, but still better than the loss down here. And then really you target the best time is to buy when these things are low. Then there's a gain here. So if we start here at 2011 when there was just kind of at the break of the market, and then some years later, there was a good year in the stock market. You bought here, that is a good gain. And years later, if you go back, you'll be back to where you started here in 2015. We're back to really zero, and then finally in 2019 we're back up. So it's buying and selling. So you need to buy and sell at the appropriate time. Again, over time, the stock market is said to return about 7%. Maybe you can do a little better. Maybe you can do not so well. But this is really how it goes. When I took these 5 years at a time, I looked 2005 to 2019. The average return, average performance of the stock market was 10%, positive 10%. 5 years prior, 2010 to 2014, 13%. 2005 to 2009, 1%, and then 2004, negative 2%. So that means during these times, there was just no gain. During this time, there was 1% gain. During the time of 2010, 2014, 13% gain. 2005, 2019, 10% gain. So if you were investing for retirement or whatever you might have had in here over 20 years, which is reasonable if you're investing or saving for your retirement, your gain on average over that time would have been about 5.59%. Keep in mind this is the S&P 500, so there's thousands of stocks on the stock exchange. This is a measure of 500 large companies, but there's large, medium, small companies on the stock exchange. So this is not everyone's average. Again, the S&P 500 is just a indice or an indicator of the stock market. So here's how a typical buying and selling stock transaction will work. I'm going to bring back in our handy calculator to show you here. Let's say you had, we're going to use $10,000 as an example. Let's say you had $10,000 that you were willing to invest. So again, all investments are a risk. So you need to be willing to accept the gains or losses, with a potential investment, no matter what the investment is. So let's say you had $10,000 you wanted to realize a gain on, so you wanted to increase the value of that money. So you had $10,000 and you had found a stock, you had researched that stock. Maybe it's a stock you're interested in because of personal interest, it's somewhere you shop, or maybe it's because of some data, the company is growing, or they're opening more stores, or they're closing stores. As you look into stocks more, some of the stock market is based on data, and some of it's based on speculation. So I'll say, for example, a store growing and opening stores, you would think that it's a good thing for the company. Some speculators would say not, or some people who would view that as, okay, they're spending money, that company may not get the return on that, so maybe I should sell that stock. Maybe that company's not going to do well in the future. And some will say, well, they're opening stores. They're, hopefully that's more income, that's more profit. The company will continue to grow. I want to invest in that stock. So there's two sides to it. You would want to research that stock, read the news about it, and make your own thought and see what others are saying too, but make your own decision on what you want to do, or consult someone who trades stocks full time, or a financial advisor who does stock trading, but either way, just want to share, again, just transparent knowledge that there's two sides to news that comes with the research of buying a stock. Well, let's say you had $10,000, you found a company, that stock price currently was $50. So you're able to buy 200 shares of that stock. So you own 200 shares of that stock. Now let's say later that stock went up to $54. Maybe it was a year later, 2 years later, 5 years later, that stock went up to $54. So your 200 shares times 54, that stock would be worth $800 more than what it was when you purchased it. So if you wanted to hold on to that stock, you could hold on to it, and maybe it'll go up more. Maybe it won't. But you would have the opportunity at any time while you own your stock. You'd have the opportunity to potentially sell it. So if you sold it, then subtracting the $10,000 that you used to buy the stock, which would be known as your basis, you would have plus $800, and that's pretty well. It's especially pretty well because, after all, you didn't necessarily do anything during that time, whatever that duration was, whether it went up $4 in 1 day, 10 days, 5 days, 10 years. You didn't necessarily do anything while that happened. You went along with life. You worked your full-time, part-time, or ran your business, whatever it is you do daily. But I will say you should, whether you hire someone to watch your stocks or do your stock trading for you, or you do it yourself, you should keep a keep an eye on that particular stock and that industry. So if you're investing in the energy industry, maybe it's a good idea to know what the industry trends are, know what that company's doing. Are they buying? Are they selling buildings or properties or businesses? Is their growth increasing? Is their growth decreasing? Did they have a good quarter or a bad quarter? Typically, companies, they can do it at any time. They can release news, but typically at least quarterly they will release throughout the year quarterly a financial report on that company. So it'll include news and it'll include numbers in terms of what transpired in the prior quarter for that company. So besides just watching the news and making sound decisions on whether you want to keep holding the stock or if you want to sell it, you didn't do a whole lot. So some people might consider that passive income, where you're not doing a lot for that return. Remember, I mentioned earlier time for money. In terms of like a job or a career you're in, you usually trade your time on the clock or your time for your salary you earn. With this, you didn't. So some people might consider it passive income, which is when you receive a return on your investment or you receive income and you didn't necessarily trade what you see as an equivalent amount of time for it. So when you go to work each day or go to your career each day or whatever you do each day, in return for a wage or a salary, you may see that as an equivalent time put in for that dollars. Now, if those dollars came and you didn't do a lot or you didn't do anything, you might consider that passive or some other type of income versus earned income. Earned income is when you trade your time for a equivalent salary or wage. Now, stock trading is not passive income. It has its own area. It's called portfolio. So portfolio investing is what stock investing is. We're going to talk about passive investing and active investing, and we'll get to that here in a moment. But this is pretty good, right? I mean, you put your money away, you came back, and if we look back at that, if you think back to that chart we were looking at earlier, you're on the fast track. You are, instead of the 0% gain, like a local savings account, nearly online savings account about 2%, inflation being also about 2%, you're on the fast track. You're on that yellow line. So that's really good. The data in this chart is courtesy of www.macrotrends.net. So you can research stocks and data from various sources, but I found that this site provided good data, and then I was able to put it in a chart for you to make it easy to see. And then I was also able to separate it for you into 5-year segments just so you can see what the pluses or gains or losses would be over 5 years of investing. Now, I mentioned there was 2 avenues that we were going to talk about with the stock market. The first was buying and selling. We just looked at that, looked at some periods of time over the last 20 years, looked at an example of if you had $10,000 to invest and you purchased a $50 stock. Using that same example, there's also something called dividends. So this is what not all stocks or companies that list their company on the stock exchange will provide you a dividend, but some will. And this is going to give you an example of what that looks like. So a dividend is measured typically in an annual yield or a annual dollar per share or cent per share that the company gives to its shareholders, which would be you when you buy their stock. I guess you could say it is a thank you, but it's just some type of return on your investment during the time you own it. Because thus far, if you remember, to gain that $800 on the $10,000, we had to sell that stock. So you no longer own it anymore. Once it's sold, then you have $800 back, you have your $10,000 back, and you can go buy another stock. Or you can leave the $10,000 in the same stock and sell that. Or you can sell a portion of it. Maybe you sell half of it, you sell the 100 shares and go buy a different stock or something, either complete sale or something in between, like a partial sale. So you no longer own that stock. You no longer get any more returns. It's just back into your
savings account, and it sits there until you decide to do something else with it. So dividends typically paid quarterly throughout the year to make up an annual return. The companies, again, they'll pay you this typically quarterly, and it's where you can receive income or a return on your investment in their stock while you still own it. Other than that, again, buying and selling, you can only calculate your gain for the most part while you own it, but it's not until you sell it that you realize that gain, that return on that investment actually comes back into your bank account. But otherwise, everything is just on paper in terms of your gain. But with these dividends, you have the option of reinvesting or taking them out back into your bank account. So let's take a look at another example. We'll keep the $10,000. We'll keep the $50 stock. $10,000 will buy you 200 shares of a $50 stock. Based on a $2 annual dividend, $2 times 200 shares would net you or yield you $400 per year. Again, that is, if we look at that, that's 4%. That's not bad at all. Again, you didn't do anything. You did do your due diligence up front to decide that you wanted to buy that stock based on whatever your criteria was. You saw the company was growing, a company you like, whatever your criteria was. It came as a referral or recommendation from someone else based on public knowledge that was out there about that stock or that company. And you watch the news quarterly. You watch the financial reports maybe quarterly or yearly on that company. But you didn't go to that company and do any work. But they paid you a dividend. This isn't a bad thing, right? This is good. This is still above your local savings account. This is above online savings account, and most importantly, it is above inflation. So you are not just trying to keep up. You're not just staying afloat. You are ahead at this point, as you see with these investments, and that's what I want you to be able to see. That's why I'm here. So as we looked at this chart a few moments ago, we saw the volatility, the ups and downs. We saw big gains and big losses. So how do you avoid the volatility? Or how do you reduce the volatility so that you can sleep at night and not being worried about waking up one day and your hard-earned income or your returns being gone due to speculation, politics, or something else totally out of your control? Speaking of control, you should know that you have very little control of your investment in the stock market. Your control starts and stops with the due diligence you do up front before you purchase the stock or stocks, and the continued periodic research and review that you do based on the financial reports that come out quarterly from the company and any news that gets published as well. The company will continue in its day-to-day activities. They'll do what they think is best for its shareholders and what they think is best for its business, but their decisions impact the company now and in the future. They may make changes or come up with ideas that they think are great for its customers, but their customers may not receive it the same. They may lose those customers, and that may impact the financial reports, which eventually will trickle down to the shareholders when they review the reports, and that might cause shareholders like yourself to sell the stock and the stock price to go down. If the changes or new ideas from the company are a large impact and make a big enough wave, it could become public news. And if that news is unfavorable or seen as unfavorable by many, that could cause the stock to be sold and for the stock price to go down. Or the news could be favorable and that could cause the stock price to go up. You see, this is where part of the volatility in the stock market comes from. There's no doubt that the stock market is a popular place to plop your money. You can't go too far without hearing about Wall Street and Wall Street versus Main Street and the Dow Jones and the NASDAQ and what's the S&P 500 doing for the day. But do you know where the most wealthy get their wealth? What their main sources of income are? Yeah, there's some from the stock market, but most of it's actually from private equities or investments in private companies that are not listed on the stock market. And also, from, you guessed it, real estate. So in the next show, we're going to get into real estate. We're going to dive deep into a few factors to help you attain wealth in real estate. Cash flow, sell or refinance income, which typically comes from appreciation, and mortgage principal paydown. Now, this information has been for you to learn, to understand, to obtain knowledge to help you meet the financial goals for your family, for yourself, and maybe for generations to come. Now, what benefit would it be for you to meet those goals, to succeed, and not share with others? So do this. Share this show with someone else, a friend or family member, someone else you want to succeed, someone who might come with you on your journey, or someone who might start one of their own. My pastor at times quotes others, and one quote that he often shares is, once the mind is exposed, it can never go back to its original form. So expand someone else's mind, and I'll see them and you back here next time. Hey, I hope you enjoyed the show. Before you leave a comment or ask a question. I read them all, so if I can make the show better for you, I will. Your question might even end up as a topic for the show or a part of question and answer shows in the future. If you want to engage further on bringing real estate investing into your plans, I am at neelyrealty.com/engage. That's NILEE realty.com/engage.